Good afternoon, ladies and gentlemen, governors, distinguished guests. Welcome to the executive panel on financial stability and the post-crisis reforms. Are we done yet? My name is Babak Abbaszadeh. I am the CEO of Toronto Centre and your MC for today. My role is to limit my presence here as little as possible so you can take advantage of the distinguished panel we have. We were established in 1998 to promote financial stability and financial inclusion. We do this by building the capacity of financial sector regulators around the world. And since 1998, we have trained more than 10,000 officials from 190 countries and territories. Today, we're also proudly celebrating our 20th anniversary this year. I hope you've had a chance to watch our anniversary video, and I premise my comments so that you have watched it. And we have placed a couple of memorabilia on your table for you to take home. Toronto Centre's work is generously supported by our key funders, Global Affairs Canada, the Swedish International Development and Cooperation Agency, and the International Monetary Fund, who share our concern for financial stability, financial inclusion, and global poverty reduction. We're also indebted to two of our original founders who are here today, the World Bank Group and the Schulich School of Business. And for our audience internationally, so this program is taking place in Toronto, and we'll be providing you with additional links as we go. We have assembled an excellent Canadian and international panel of speakers for you. You have received their bios. So the deal is for me not to read their bios word by word, but I'm going to give a little bit of a context to some of them. So now, to get our program started, I will now introduce two of our founders who play an important role in today's program. Let me start with introducing our chairman and moderator, and then I will introduce our host and opening speaker. Mr. John Palmer has been on the board of directors of Toronto Centre since 1998. He became the chairman in 2005. He has served as the superintendent of OSFI and as Deputy Managing Director of the Monetary Authority of Singapore. He was KPMG's Canada's Deputy Chair and Managing Partner. He has been a member of the Basel Committee for Banking Supervision, the Financial Stability Forum, CDIC, and the Central Provident Fund of Singapore. He's currently a Director of Manulife and Fairfax Financial. In 2014, John received the Order of Canada for his outstanding contributions to the regulation of Canada's financial institutions and for his role in establishing the Toronto Centre. So at this point, I'd like to introduce our opening speaker and host for today. So we're very lucky to be here at Schulich Executive Training Center. Deja Horvat, our host, is the Dean and Tana H. Schulich Chair in Strategic Management at the Schulich School of Business. On becoming dean in 1998, he successfully transformed Schulich into a globally top-tiered business school. The dean oversees various Schulich advanced programs in Beijing, Mumbai, Shanghai, Seoul, Mexico City, and Sao Paulo. Dean Horvat is one of the founding members of the Toronto Centre and has been on our board of directors since day -1. He's also the director of a number of companies and organizations, and serves on the advisory boards of various business schools around the world. He was named 2004 Dean of the Year by the world-renowned Academy of International Business in recognition of his outstanding leadership in various aspects of internationalization. I like to hear that word more, internationalization, today. In 2008, Dean Horvat became a member of the Order of Canada. In 2012, he received the Queen's Diamond Jubilee Medal in recognition of his achievements and significant contributions to Canada. In 2014, he was selected by the Toronto Star as one of 180 most important people, past and present, who have helped shape the city of Toronto since its founding. So Dean Horvat, if I could ask you to please come forward.
Thank you, Babak, and good afternoon, everyone. I would like to begin by congratulating everyone associated with the Toronto Centre on this milestone occasion. And it's actually quite a few people around here at different stages of the Toronto Centre's development has been associated with the Centre. Welcome back, all of you. Over the past decades, the Toronto Centre has created a truly lasting legacy. I will repeat, more than 600 programs being delivered to more than 10,000 financial sector regulators, supervisors, and central bankers from 190 countries. That is a remarkable impact. This university is very special for me because I am one of the few individuals here today, along with the board colleague John Palmer, who was involved in establishing Toronto Centre from day one, actually before the Toronto Centre started. I would like to share with you a few stories from those early days. In the mid-1990s, I had the good fortune to hire Michael McKinsey as one of our executive residents at Schulich. Michael, as you may know, was the first OSFI superintendent in Canada and had recently retired from the organization. Following discussion with John Palmer and I believe Tony Maxwell at OSFI, John Palmer succeeded Michael McKinsey. Michael approached us at Schulich and proposed a collaboration with the World Bank. Our objective was to establish an executive development institute for financial sector regulatory supervisory agencies. And its focus was primarily on agencies in emerging markets and developing countries, economies. Nothing like it existed anywhere in the world at that time. The institute would seek to develop the leadership capacity of senior officials in these agencies, not technical support or anything like that. I immediately endorsed the concept and offered my support. It was the summer of 1997 when Michael and I went to Washington and met with officials from the World Bank. And I loved the Toronto Centre concept. That was really the starting. So on our return, we directly went up to Ottawa to meet the then Minister of Finance, Paul Martin, and he really loved the concept. He loved it so much that shortly after our meeting, he announced a proposal to establish the Toronto Centre at a summit of G7 finance ministers in Hong Kong. That was really the starting point. That created the basics to start the centre. And soon after that, the Minister of Finance provided us with the initial financial support, which was later on taken over by CEDA and more recently by Global Affairs Canada. Over the next year, Schulich hosted a working group that established the original Toronto Centre. The working group, which was chaired by actually Seth Ritchie from Bank of Nova Scotia, consists of Seth Schulich, the World Bank, and the Canadian government, represented both by Ministry of Finance and OSFI. And soon after, also IMF became one of our members and founding members. I should point out that the working group also included several leading financial supervisors from around the globe. What these individuals all had in common was that they led their own national agencies through one type of crisis or another. Schulich helped write and deliver detailed case studies of those crisis experiences. Actually, we have one of the case writers here with us today. Back then, we ran only a few programs a year, most of them at Schulich. Today, under the chairmanship of John Palmer and the executive leadership of Babak, Toronto Centre is offering more than 70 programs a year in Toronto and around the world. I am proud to have been involved as a founder and a board member from the very early years, and I'm also proud of all that we have accomplished over the years. At Schulich, we understand very well the importance of emerging markets and developing economies. We are, after all, Canada's global business school with satellite centers, which you already heard: Beijing, Shanghai, Seoul, Mumbai, Mexico City, Sao Paulo, but also with campuses in India and China. An academic exchange partnership with 8 international business schools in over 70 countries, with graduates in over 90 countries and alumni chapters over 70 countries. The other key point I should also like to mention about Schulich is that our school has always been a strong advocate of to take into consideration of views not only of shareholders but all stakeholders and take the longer term perspective, long before this concept became an accepted, not norm, but development in the world. We have always taught the stakeholder model of management, a model with long-term, especially long-term orientation and social responsibility. This perspective is important not only in the private, but also the public sector, which is the focus of the Toronto Centre efforts. Despite of a lot of good work, since the economic meltdown, I don't think that the potential financial crisis have been fully eliminated. We will have more turbulence, more unexpected black swans, so we need to be prepared. We need to also realize that we are in the early stages of a major revolution in financial services, a revolution driven by digital world and the innovative use of technology. So digital transformation is a reality, maybe influencing financial services sector than any other sector today. This revolution is going to be disruptive and it will affect many stakeholder groups. Toronto Centre will provide invaluable assistance to help financial authorities around the globe deal with these challenges. The world needed the Toronto Centre 20 years ago, and it needs us today more than ever before. Thank you, and I have an announcement to make otherwise. Before I end my remarks, I would like to take a few moments to acknowledge the dedication and service of John Palmer. For any of you who knows John, he is a very humble individual, so I will not spend too much time highlighting his generous contribution to the Toronto Centre over the past 20 years. As a founder, as a board member, briefly as a president and CEO, and as chairman since 2005. It is my honor to announce the establishment of the John R.V. Palmer Scholarships. No, we will look after that. These scholarships will be awarded to deserving candidates from developing countries to attend our core curriculum certificate course. John was a principal champion of developing this cornerstone program, which focuses on the practical and fundamental knowledge and skills that are also important for financial sector supervisors and regulators. Please join me in congratulating John. Thank you, and enjoy the 20th anniversary celebrations.
Thank you, Dean. That's great. Also, at this point, I just wanted to mention, unfortunately, the former Prime Minister Paul Martin couldn't be here, but I would like to ask one of our board members, Mr. Barry Campbell, who was the Prime Minister's former parliamentary secretary, to come and read the message from Paul Martin. And Barry, for those of you who don't know, is one of the foremost advisors on public affairs in Canada and a noted international trade and competition lawyer from one of his past lives. Barry, thanks.
Thank you, Babak. Thank you, Babak. When I phoned Paul Martin last week, when I understood he couldn't be here, to ask him if he would honor us with some remarks on this occasion, he said, "Who's your chair?" And I said, "John Palmer, of course." It was a long pause. And he said, "Who else you got?" So, in fact, as I look around the room, I see lots of people that I remember from my time in government and people who have served. alongside Paul Martin, or worked for Paul Martin, and I'm sure if he could be here today, he would have a lot to say to each and every one of you. But this is what he asked me to say to you today. From the Right Honorable Paul Martin, please express my regrets to everyone for my absence today, and please thank John Palmer for the tremendous work he and the team have done all these years. The Toronto Centre is a huge success, and all of us who have witnessed its evolution are extremely proud. I understand that Bill White will be speaking on the post-crisis reforms. Are we done yet? I suspect the answer will be no, and the Toronto Centre will have its work cut out for it over its next 2 decades. I can't think of a better organization to take it all on. Happy anniversary. With best regards, Paul Martin.
That's great. Excellent message. So at this point, just before I introduce our keynote speaker, I'd like to thank our staff who worked so hard to put this program together, and Tui especially, and everyone else that I'm not naming right now, but thank you. These things are not easy to implement. This is the second occasion Mr. White has spoken at the Toronto Centre event. The last one was a little bit more private, so I'm glad that this one can be broadcast. In 2009, William White was appointed the chairman of the Economic and Development Review Committee at the OECD in Paris. He also served on various working parties and committees of the OECD, such as the ISIN Committee, advising the German Chancellor on G20 issues. Mr. White was presented in September with the 2016 Adam Smith Prize, the highest award of the U.S. National Association of Business Economists. In May 2015, he was honored with the Hans Muller Medal from VAC, the alumni club of political economists at Ludwig Maximilian University in Munich. Prior to that, he received the annual prize of the Monetary Workshop in Monetary, Financial, and Macroprudential Policy in Frankfurt in May 2014. And these are the only awards I'm mentioning. There's a lot more. And he, prior to the OECD, Mr. White had a distinguished career in key organizations in several prestigious institutes around the world and central banks, such as the Bank of England, where he started his career, followed by a 22-year career at the Bank of Canada, culminating in the position of Deputy Governor. After the Bank of Canada, he held senior positions at the Bank for International Settlement in Basel, Switzerland, including as the head of the Monetary and Economic Department. On top of all this, he has also been an active participant in the many international fora, such as the G10 Deputies and the Bellagio Group, which brings together senior government officials, central bankers, and academics. Please join me in welcoming Mr. White. By the way, if you need a standing room, we also have an overflow room in case you want to watch it from there. And there's some refreshments there as well. Thank you. I think you're mic'd up, right?
Okay, well, thank you very much for that gracious introduction. I'm actually honored to be here today, particularly given the quality of the panelists, many of whom I've known for a long period of time. Could I also say that I want to congratulate the Toronto Centre, because I think everything that the Dean just said is absolutely true. It's been an enormous contribution over an extended period of time. And as my remarks will make clear, the contribution is not over yet. And lastly, let me just say a word to John Palmer. I've known John for about 20, 25 years, if not longer, mostly on the international scene. First here in Canada, but then on the international scene. And John is the absolute archetype of what a Canadian abroad is supposed to be. He is as nice as he is competent, which says a lot, and the level of niceness and competence is extremely high. So I think the Centre in Canada has been really very fortunate to have him working for them for such a long period of time. Well, let me move on to the topic at hand, which is financial stability. Post-crisis reforms, are we there yet? Before addressing the question directly, what's happened in the post-crisis period and how do I see the sort of future unfolding in a sense, let me give a little bit of background, because the point of the matter is that the economy is not a machine in which you make policy changes, you change the policy levers, and you predictably get something out at the other end. It's not the way it works. It's all systemic, interrelated aspects of policy and the functioning of the economy. In the jargon, it's a complex adaptive system. And one of the points that I want to make sort of up front, and I hope some of my central banking colleagues will not be really upset about it, but I think the central banking establishment and the conduct of monetary policy over the course of the last 15 or 20 years has not made the job of the regulators any easier. So let me just say a few words about that. Monetary policy since the crisis. You will all remember in 2009 and 2010, basically when the crisis hit, every policy instrument you could think of, all the stops were pulled out. So we had fiscal expansion, both automatic stabilizers and discretionary expansion. We had monetary expansion. We had cars for clunkers. We had short time working. I'm taking a global perspective here now. So basically everything that could be done, it seemed to me, was done. But very quickly what happened was that people began to recognize that all of these policies have got both short-term benefits and long-term costs. So you think about fiscal expansion. Well, they backed off fiscal expansion because it was pushing up the debt levels too high. So fiscal expansion was off. Cars for clunkers didn't make much sense in economies like the US where consumption was already 75% of GDP. Short time working, the same kind of thing. It impeded the longer run adjustment to the challenge of the emerging market economies. So basically people backed off everything. And even regulatory policies, it seems to me at the time, is that the regulatory apparatus went almost directly into crisis prevention mode. They knew that a lot of mistakes had been made and we're not going to make those mistakes again. But what somehow got lost in the traffic was the whole issue of crisis resolution. And we're going to put these problems resolutely and finally behind us. So, but regulatory was also moving in a kind of, what's the word, a constraining kind of mode. And in the end, what you were left with was monetary policy as the only game in town. And what we've had since the crisis really was just a repeat of what we had in all the previous downturns, which is monetary policy was very, very easy for an extended period of time. And the premise of the policy, basically two of them. One of them was that it would work to stimulate aggregate demand in the way that it had always worked in the post-war period. And as I'll just note, that premise proved to be false. And the second basic assumption, which I'll get to in the next slide, was that the side effects of easy money basically were so minimal as to warrant not thinking about them a very great deal. Well, the first point here, the second last bullet, in fact, we've had unexpectedly weak effects of these extraordinary monetary policies over an extended period of time. So we had 9 years, for example, where the IMF, the OECD, and probably many of the forecasters in this room forecast 9 years in a row where everybody forecast growth would be much stronger next year and inflation would go back up to the target. And it didn't. And then the next year, for 9 years, they had to do the same thing all over again. Well, the funny thing is that these policies, this expansionary monetary policy, is often referred to as Keynesian. It's the last thing that a Keynesian policy is. Because you will remember, at least some may do, when Keynes wrote the treatise on money in 1931, okay, he recommended in that document all of the monetary policies that we've subsequently been following. But by 1936, when he wrote the general theory, the line that I like is in chapter 13, where he says, if we are tempted to assert that money is the liquid that activates the system to activity, we had best remember there are many slips twixt the cup and the lip. And then he goes on to give a very detailed explanation of why it won't work. Well, that's one side. So premise, it will work, it hasn't. So we've had many, many years then of this I'm sorry, I pressed the wrong one. Many, many years of these easy monetary policies. And I think that they have increased the threats to financial stability. I know this may sound contentious to many, but I believe you can make a reasonable case for it. First point I'd make is global debt levels are now 40 percentage points higher than pre-crisis. So that at the end of 2017, if you calculated the numbers as the BIS did, the total of non-financial debt, which is corporate plus government plus household, was 232 percentage points of global GDP. And that contrasts with 192% at 2007. So there's a tendency to think when you have these big crises that we had periods of leveraging and they're followed by periods of deleveraging. But the honest reality is that hasn't happened. This debt problem is now significantly bigger than it was before. And whereas in 2009, I think it was fair to say the problems that we went through were the problems of the advanced market economies, this problem has gone global, okay? Which I guess is going to make the contribution of the center even more important going forward. It's gone global, okay? And the particular thing that I'm concerned about is emerging market corporate debt, and particularly Chinese corporate debt, okay? The numbers there are huge. The BIS calculates there's now $11 trillion worth of debt that's been issued in dollars, that's been issued by people that don't get their revenues in dollars. Okay? This is going to be a problem going forward. Many assets seem richly priced. I don't have to tell anybody in Toronto who's been looking at houses at a lot of and I don't need to tell Stefan Ingves about house prices in all of the Nordic countries. You look at the financial assets, you might say, well, treasuries are, US treasuries fairly priced 3%. But when you look at $10 trillion worth of European sovereign debt trading basically around zero or below zero, there is something totally unnatural about that. This is not going to continue. It can't continue. And then you look at all the other stuff, the credit spreads and the high yield spreads and the VIX. And, there's a lot of anomalous prices out there that have at least the threat embedded in them that they will fall back to lower levels. Business models have been threatened and risky behavior encouraged. You all know this as well as I do. Pension funds, insurance companies, and even banks. Okay? With the very low interest rate levels, the margins have been squeezed down to nothing. These people have got real problems. And the business models of many of them are threatened. I talked to many people in Europe in particular where I live. And risky behavior has been encouraged. And I think there's absolutely no question about that. You read some of the items in the press, for example, about covenant-like loans, okay, now make up something like 70 or 75% of all the recent sort of junk bonds that have been issued. So there's been a change in the character of the situation, of the system involved with this. And lastly, again, with the sort of side effects of these policies, zombie lending. You see a lot of this in Europe, not least in Italy. Companies that are kept alive because the banks can't take the hit. Okay? Companies have been kept alive. And because the bankers themselves are so preoccupied with dealing with the old stuff that's threatening, the new people that are coming in looking for loans because they're guys in garages that have got good ideas, they're not getting the money. And this is a threat to productivity going forward. And of course, you hear more and more people saying in the financial markets, the only thing that counts is what's the central bank going to do next. And so that basically means price discovery has disappeared. Price discovery is the essence of good investments and productivity going forward. So I think there have been a lot of unanticipated consequences here that really do constitute a threat to financial stability going forward. I could go on, but I haven't got enough time. Let me just say that if you look at this whole sort of debt thing, financial markets thing, globally, every area that you look at seems to me to have problems. And what makes it even worse is that every area you look at, there are political dysfunctions that I think have the prospect of impeding getting the kind of economic solutions you need. So we have some issues out here. Well, I would have to say, in terms of what the regulatory community has done, there's been an enormous amount of effort that's gone into this. Stefan, of course, has been the head of the Basel Committee, which was the first of the big committees to get involved. Then there was the Financial Stability Board, headed up by our own Mark Carney. There have been enormous efforts that have been made in this area. And I guess I would point out more and better capital and liquidity for banks. There's absolutely no question the definitions of capital are now much more demanding than they were before. The levels of capital are much higher than they were before. Attention paid to liquidity, both short-term and long-term, a lot greater than it was before. So these things are all to the good. I would say pre-crisis, the focus was almost entirely on banks. And now there's been a welcome extension of all of that, particularly under the Financial Stability Board, to non-banks. And in a sense, it's not surprising because, of course, the previous crisis in large part started with the shadow banking system. So, you know the old line, even an economist, when he sees something happen, will admit it's possible. So it happened, it's possible, and a lot of attention has been directed to it. And I think that's all very good. Insurance companies as well. Much more attention to systemic risks. I would say prior to the crisis, the message I took away when I was at the BIS was, if the individual banks are healthy, the system is healthy. And now we know that's not true. Okay? So you can have everybody looking healthy, but if they're all exposed to the same shocks and they're all going to respond to the same shock in the same way, you can see the potential for fire sales. And okay, so looking at it from a systemic perspective, I think, is something that's now much more at the heart of what's going on. And of course, that too, I think, is a good thing. Greater efforts to reduce procyclicality, this whole business about credit booms and busts and what can we do about it. And we've now got the sort of the anti-cyclical buffer for the capital requirements, which is helpful. And I would note, I've been in the international business now for like 40 years. International agreements are hard. I mean, everybody is going up to the table, basically fighting for their own interests. And getting something done in a relatively short period of time is not easy. And the people in Basel, the supervisors, the FSB, have done an astonishing amount in the period of time since the crisis began. Well, are we out of it? I'll come back to monetary policy in a minute. I don't think we are out of it. I think there's an awful lot of challenges that are still out there. One of them, and I said right at the beginning, the economy is a complex adaptive system. The one thing to recognize about complex adaptive systems is every action will have unintended consequences. Okay? And I talked about monetary policy and unintended consequences. Regulatory policy is going to have unintended consequences. And Mark Carney, I think just last spring, wrote a letter to the G20 in which he explicitly recognized a number of the unintended consequences, and not least of which was reductions in liquidity in capital markets, right? To go with various provisions of Dodd-Frank that will prevent, as I understand it, I may be corrected, that will prevent the Fed from doing some of the stuff that it did last time when the crisis hit. So we've got some issues out here in terms of unintended consequences. Boundary problems. Again, think systematically. When we first started talking about regulation, you talked about bank runs. Okay? You've got to stop bank runs because bank runs are very expensive. So how do you stop bank runs? And the answer is safety nets. You say, but if we have safety nets, then there's moral hazard. So we're going to deal with the moral hazard through regulation. But regulation just invites evasion. And then you get into the shadow banking system. So you turn your attention to the shadow banking system and people just go elsewhere. So this is what I call the sort of the whack-a-mole solution. This is going to go on forever. And it's a problem that everybody will have to face up to. Third thing is financial innovation. This goes on all the time. And if it's financial innovation that is a response to financial regulation, makes it even more difficult. The regulators are always going to be one step behind. So there's going to be jobs forever. They're constantly going to be confronted with this kind of stuff. And the disruptive technologies, and Dean made a reference to it. You think about things like cryptocurrencies and, fintech, I should say. And the problem with it is that if you have a disruptive technology in lots of areas and the companies go bankrupt, the old companies go bankrupt, you say, hey, it comes with the territory. But when the people going bankrupt are the center of the banking system, we have a whole different set of issues. And this is, again, something that we're going to have to deal with. And lastly is the lobbying and the implementation challenges. And I've been reading more and more about this stuff. Many of you are more familiar with this range of territory than I am. The lobbyists who want you to back off, both in the severity of the regulations and on the implementation. And if it works disproportionately in different countries, then of course you've got the problem of cross-border arbitrage and all the stuff that comes out of that. So again, there's a whole sort of series of things that we have to be conscious of. Well, the last slide. I'm just going to assert that the sort of the monetary regulatory system that we've got is not optimal. In fact, it's not a system. So at the domestic level, some combination. At the domestic level, the fundamental problem is we have chosen to have a fiat money system, which has many advantages to grease the wheels. Okay? It also has many disadvantages. And the boom-bust cycle stuff is very much part of it. By the same token, we have no international monetary system. We have nothing. Okay? There is no discipline to prevent people from doing whatever they want to do at the domestic level. And sadly, in the course of the last 7 or 8 years with QE and all the rest of it, everybody does do whatever they want. And I guess I'm just going to assert that a system that basically relies on every man for himself and sauve qui peut is not much of a system. Well, what can we do about it? There's more and more attention being paid to radical solutions. Free banking, narrow banking. Next July and June in Switzerland, where I come from, there will be a public referendum on narrow banking. Okay? They got 110,000 signatures to say this is what we ought to do. I don't think it's going to pass, but a lot of interest in radical reforms. I don't think they're going to happen. They're too radical. People have not thought enough about the unintended consequences. There are other things that we could do that would be less radical. I think over the years, people have pointed to globalization, consolidation, securitization as being developments that, again, have big benefits, but also big costs. Maybe we could roll them back. I see no appetite for that either. So what are we left with? I think what we're left with is the center and other people who are involved in the regulatory business recognizing that they have to continue doing the good work that they have been doing, that the job is going to be never-ending, that more radical approaches will not be forthcoming, and they've got to get on with it. And I guess the good news is that while this may be an imperfect solution, it's one that sort of has served us pretty well up to the present day, and it will ensure that the Toronto Centre and other groups, not like them, but contributing to the same end, will have a lot of work to do, both in being prepared for the next crisis, probably from some unexpected quarter, and in being capable of dealing with the crisis when it happens. So I thank you for your attention, and I'm really looking forward to the panel. Thank you.
Bill, thank you very much for that. Babak mentioned that Bill, this is the second time that Bill has addressed a Toronto Centre event. The first time was actually some years ago when we were so frightened, Bill, that it's taken us a long time to have you back. And now you've done it again. But you've done it in a very interesting and provocative way, and hopefully that will serve as a useful catalyst to our panel, and perhaps they will calm us down. So we're going to move into the panel discussion, and let me explain how it's going to operate. There are going to be 4 rounds of questions directed at the panel. In the first round,
I will ask questions to each panelist about the effectiveness of the post-crisis reforms. In the second round, I will ask a question about risks to the financial system that have emerged since the global financial crisis. In the third round, we're going to take questions from the floor. And then in the fourth round, I will ask some summary questions to each speaker, and we'll also give Bill White a chance to respond. We will have to move efficiently to fit all of this into our allotted time, so each speaker will have no more than 5 minutes to answer the question posed to him or her, and I will enforce that limit with vigor. I have a bell over at my seat. It now gives me great pleasure to introduce our distinguished panelists. You already have copies of their CVs, so I'm not going to take the rest of the afternoon going through in detail their distinguished careers. But I would like to provide these summary introductions. The first is Stefan Ingves, governor of Sveriges Riksbank. That's the central bank of Sweden, and also chair of the Basel Committee on Banking Supervision. Stefan is also a longtime board member of the Toronto Centre. Next is Maureen Jensen, chair and CEO of the Ontario Securities Commission. She has held other senior roles at the OSC and also the Investment Industry Regulatory Organization of Canada. Before that, Maureen had a successful private sector career. She is also a board member of the Toronto Centre. Our third speaker is Honorable Kevin Lynch, Vice Chair of BMO Financial Group, and a former senior public servant in the Government of Canada, holding several top posts, including Clerk of the Privy Council, Secretary to the Cabinet, and Deputy Minister of Finance. Our fourth speaker is Ceyla Pasarbasioğlu, Senior Director in the Finance, Competitiveness, and Innovation Global Practice of the World Bank Group. She has held other senior roles in the World Bank and the IMF, and also the Banking Regulation and Supervisory Agency of Turkey. Ceyla is on the board of the Toronto Centre. Last but not least is Kevin Steiro, Executive Vice President of the Federal Reserve Bank of New York and head of the bank's Supervision Group. Kevin has held other senior posts at the New York Fed and was deeply involved in the actions taken to stabilize the financial system following the crisis. Please join me in welcoming our panelists. Now I'm going to move to my bell and we'll move to the questions. So I'm directing the first question at Stefan Ingves, who is conveniently just to my left. From your perspective as chair of the Basel Committee, how would you summarize what the committee has achieved with the Basel III reforms? What might not be appreciated by the casual observer? And finally, has anything been left undone?
So, well, this is tough to do in 5 minutes, given that actually there exists a document called the rules text, which is hundreds and hundreds of pages with technical stuff describing what this is all about. But let me try to summarize it anyway as best as I can when it comes to where we are and where we come from. First of all, just finalizing this thing called Basel III is a landmark achievement in itself, because it took many, many years to get this thing done, and it required a lot of hard work by a very large number of people globally to get to an agreement. Basically, this reform is about how to regulate what banks are allowed or not allowed to do, mostly actually dealing with credit risk, a lot of other things too. But normally banks go under because they've taken too much credit risk. So that's the core really of the system. First thing was to put in place a better, more modern, more robust, standardized approach for dealing with credit risk for banks. And the reason for this was very simple, because Basel I was done in the 1980s, and there aren't people around who remember what it is, and the rules text is getting old and stale. The other part of it, which is important, is to constrain what banks are allowed to do on their own, because the conclusion from the disaster was that there were too many degrees of freedom in this. And in addition to this, add a leverage ratio and what is called the capital floor, how you are allowed to calculate the risk weights for banks. First of all, when it comes to the standardized approach, nothing much in terms of overall capital, but hopefully a better system compared to the old and stale system that we used to have. It holds actually an element of reverse engineering, and that's why the numbers haven't really changed, but it's modernized. The other part is dealing with what is called the internal ratings-based approach, putting in constraints on what banks are allowed and not allowed to do when it comes to calculating probabilities of default and things like that. Basically saying that it's too hard and there are too many degrees of freedom when it comes to dealing with risk weights. When you have a claim, one bank has a claim on another bank. Same holds for very large corporate because they rarely go bankrupt. Another issue that took us many years to settle was to put in a very simple standardized approach for dealing with operational risk, because the conclusion was, despite many rocket scientists working on this for years, it didn't make sense what they came up with, so we just decided to stop it. And it actually took 2 meetings to stop it, because the rocket scientists started meeting secretly behind my back. But eventually we got it done. So a very simple system for dealing with operational risk. And in addition to that, a leverage ratio and a higher leverage ratio for globally systemically important banks. And all of this is put in place. What took a long time to settle was essentially the relationship between the standardized approach for calculating credit risk and internal models. And the old system gave banks too many degrees of freedom, and ultimately it took quite a negotiation to come up with the number 72.5. Not scientific, a consequence of a long and winding negotiation. Basically saying that if you use your own models, they can never produce risk-weighted assets lower than 72.5% of the standardized approach. That's essentially a constraint on the whole system. Now, then what does it mean then to get this thing done? Well, most of this will start in 2022. And then there is a 5-year phase-in for the risk weight floor, so that will be completely phased in by 2027. Now, what to say about that? It took 10 years to put the pieces back together. It took another 10 years to phase in this whole thing, so 20 years. So on average, in many countries, you have a financial crisis after 25 years or 30 years, so it's just about time for the next one. Whether the numbers are right or wrong, time will tell. But at least it's more capital and it's better than what we used to have. And so far, so good. Whether it's good enough, just impossible to say. A few more things that we have to do. We came up with a system for trading book risk that was so complicated, so neither the rocket scientists nor the supervisors could implement it. And that's kind of a failure. So then we have pushed it into 2022, and now we're kind of at it again, trying to simplify. And it's hard to simplify because if you have a bunch of mathematicians on the private sector side and a bunch of mathematicians on the public sector side, they just love to add equations. And then it's in meetings where Jeremy and I attend that we take some of the equations out, saying that this is just too hard to understand. It has to be simplified. And that's what we're working on, hoping to get it done by 2022. Next phase then of all of this is to make sure that most of this ideally is implemented all over the world. And that has really surprised me in the process that we put together 4 or 5 years ago, because 20 years ago, people would never, ever have accepted groups of experts coming from the outside, taking a look at what you do. But now that is generally accepted, and that's absolutely remarkable that that's the way it is. So this is called the Regulatory Consistency Assessment Program, and that's put in place hoping that we can keep all the members of the Basel Committee on the straight and narrow path when it comes to this. In a legal sense, you can go astray and do whatever you want, but the world actually has changed when it comes to this type of work, because now people accept much more transparency than in the past. So if you try to do something completely different because you don't want to do this, eventually you probably end up with the problem being a member of the club. Because being a member of the club is actually means that you are expected to adhere to what has been agreed. Having said this, looking a little bit forward on the technical side, much more cyber risk, IT problems and this and that, and also IFRS 9 and what that might mean in terms of how you calculate capital in a more forward-looking way. But so far, so good. It's remarkable that it took 10 years to put the pieces back together. If you've been at something for 10 years, it's hard to tell whether these things really add up. So it's going to take another 10 years to figure out whether we were right or wrong. Thanks.
Thank you, Stefan. Next, Kevin Steiro. The United States, and particularly the New York Fed, were at the forefront of the firefighting in the global financial crisis, and you were in the middle of it. What are your top takeaways from the crisis and the Fed responses? Are there challenges remaining, in your view?
Okay, well, first, thank you very much for inviting me to be here. It really is a pleasure to participate in this panel. And second, I should emphasize that everything I say are my own views and not those of the Federal Reserve System. But let me take you back to the financial crisis in the United States. Over that period, there were close to 9 million jobs that were lost. 8 million households lost their homes through foreclosure. And according to an estimate from the U.S. Treasury, nearly $19 trillion in household wealth was destroyed. So this was really a traumatic event for the U.S. economy and for supervision in particular, because many of the large banks were in the middle of these changes and the impact on the economy and the financial markets. And when we look back about what went wrong and what went right, there were definitely some lessons that were learned. One was that we needed a more forward-looking way to identify risks and assess risks in the banks that we supervise. The second, we need to be especially cognizant of the gap, of the wedge between private interests and social interests. There are clearly externalities associated with individual firm behavior. There are aggregation effects. There are spillovers. There are interdependencies that cause one firm's actions to impact others. Third, in such a complex world, resilience, broadly defined in terms of capital, liquidity, governance, operational resilience, is a critical position for the firms to be in, because you don't know exactly what the next shock might be or what the next event might be. And then fourth, it was very helpful for us to think back to what it is that we're trying to achieve with supervision. And in my view, it's really to help firms through our supervisory processes to support the economy with the sustainable provision of financial services. And it's really that word sustainable that is really important. The goal is not to maximize in any given period how many loans are made or how much credit is provided. It's to ensure that banks are robust and resilient so that they can provide financial services through the business cycle, through the financial cycle, across a wide range of macro and financial conditions. So with that background in mind, it's useful to think about what happened next in the US. And two things I want to highlight are the Dodd-Frank Act and then a new approach to how we supervise the largest, most systemically important firms. So the Dodd-Frank Act was an act of Congress that had fundamental changes to some of the regulatory reform environments. A few examples are, it introduced enhanced prudential standards, explicitly mandating that the supervisory and regulatory expectations for large, systemically important firms would be higher than for other firms. That's consistent with the idea that these firms have the potential to harm not only themselves, but the broader economy. There was an expansion of the perimeter in certain cases, identifying non-banks who might be systemically important. That would go through the Financial Stability Oversight Council, who had the capacity to designate firms, non-bank firms, as systemically important. We talked about, through the Dodd-Frank Act, the creation of the Financial Stability Oversight Council, which brought together a whole range of different regulatory agencies to think about broader systemic issues and financial stability issues. Then on the supervisory side, we refocused how we think about large bank supervision. And here I'm really focusing on the globally systemically important banks. And the framework we use will be familiar to many of you who are veterans of credit markets. It's really a severity and frequency, probability of default, loss given default framework. And the idea was to align our supervisory objectives around enhancing both of those. So on the probability of default side for these large firms, it was focusing on their capital, both the quantity and the quality of their capital. It was focusing on the liquidity and reducing the reliance on short-term funding. It was thinking about their governance and controls to ensure that the risk management was appropriate and adequate for the risks that the firms were taking. Then on the loss given default side, it was really thinking more about these spillovers and the externalities that could happen should a firm, even with a more resilient balance sheet and more resilient governance structure, get into effect. You'd want the impact of that failure or that distress to be less on the economy. And there we're thinking about macroprudential effects, thinking about the importance of resolution planning and effective the ability to resolve a firm efficiently. So that's been the framework that's in place since 2012. When we jump forward to today, we're really at the point where we're shifting from building a response to the financial crisis to assessing what's working and what's not working, thinking about the efficiency and the effectiveness of the program, trying to identify where the outcomes were consistent with the intentions and where we might have unintended consequences. As was mentioned earlier, this is really difficult in a world as complex as our financial system. You're always going to have unintended consequences. That doesn't mean that the program on net isn't achieving its objective, but you need to do a careful and broad assessment of all of the impacts. And that's what we're working on. We also see the potential for regulatory and statutory change in the US. There is a bill that has passed the Senate, the Economic Growth, Regulatory Reform, and Consumer Protection Act, that changes some of the parameters in the Dodd-Frank Act. Most important for the larger firms was changing that asset size threshold for when the Federal Reserve would be required to impose enhanced prudential standards. There's also the potential for regulatory relief for smaller banks. So that's pending in Congress, and we'll see what happens there. We also have a new vice chair of supervision in the U.S., Randy Quarles, and he has talked quite a bit about the importance of making our supervisory program more efficient, more transparent, and simpler, while maintaining the core elements of the post-crisis reforms, while maintaining our focus on the safety and soundness of individual institutions, and while maintaining our financial stability objectives. And that's really the stage where we're at now. Like many other countries, like the Basel Committee, like many international organizations, thinking about and assessing the impact of the changes that have happened so far. And looking forward, I think that's how we're going to focus a good deal of our attention. Thank you.
Thank you very much, Kevin. Maureen Jensen, as Canada's top securities regulator, you have a unique perspective on the derivatives markets. Do recent reforms address the challenges of the financial derivatives markets? Are the markets more resilient? What about unaddressed issues?
Well, thank you. I thought I'd like to pick up on the point about boundary problems or boundary issues. And it's very clear on the reforms that we've been looking at since 2008 that when you start focusing and regulating within the bank sphere and really focusing on capital, if you squeeze the balloon in one side, out it pops into the market side. And so we felt it was really important to address some of the issues in the derivatives work. So I would say that, first of all, our role as securities regulators has evolved substantially since 2008. And we're focusing much more on systemic risk and working in cooperation with banking regulators to understand where the risk is going. So we've made a lot of progress. You know, you were just, someone was just speaking about it's taken 10 years to get some of the reforms in place. It's going to take 20 years before you can actually measure them. I'm always despairing of how long it takes in the securities world to get things done. But I'm pleased to report in 10 years we've actually implemented a bunch of things. So I don't feel so bad anymore. On the OTC side, OTC derivatives, we have, currently we have mandatory clearing and trade reporting rules in place. We're collecting data and we're analyzing that data. So we're now at not the rulemaking or policy stage, but very much we're focusing on what is that data telling us, and what don't we get that we need to get to understand where the risks are building. We've also published just last month a registration rule for both dealers and advisors who are actively engaging in the OTC market, so that we can understand and have some authority over what they're actually doing in their trading world. And I will tell you that one of the things that came out of 2008 is the need to focus on conduct. Because you can have all of the financial controls, all of the credit controls in place, but if you have improperly incented certain types of conduct, it will always happen and a crisis will develop. And so in this case, we're looking at the registration of dealers and advisors for exactly that, going in, reviewing conduct, and trying to understand how the incentive structure works for trading this product. Also, we're in second publication later on this summer of business conduct rules. And so in Canada, what we've done is separated both the registration and the business conduct to very explicitly state the type of conduct that we're looking for. We have mandated more disclosure on certain types of complex products, and we think that's very important, and also really dialed back and controlled the type of clients that can buy these complex products in an advisory relationship. We have implemented rules for credit rating agencies, not only for the agencies themselves, but for how they actually undertake their ratings. And this is very important, obviously, in a market-based system. We are in the process of establishing oversight for financial benchmarks. And I don't think anyone in this room has overlooked the crisis or the issue that we had with LIBOR and the impact that that is going to have on our financial system globally. And so it's very important that someone actually oversee the conduct on setting those financial benchmarks. And we're looking at policy responses to structural vulnerabilities in the asset management sector as well. That is something that has been discussed extensively at the FSB table. And so they have engaged with IOSCO, and there's a lot more back and forth now between the two groups globally. And there's a lot of uptake in making sure that we look for a system that can be shared among the world. Not everyone is going to agree, but if you can set a basic set of standards, at least you can understand if contagion goes from one region to another, actually what kind of system they're working in. So on the outcomes, I've seen that we have much closer coordination now between banking and securities regulators. And I think that it's kind of like porcupines mating. You have to be very careful, and everyone's a little worried where the boundaries are, but it's very, very fruitful. It is, it's exactly what we need to have happen, because we each see part of the story in the mirror. We don't see the entire story. So it's important to put that together. And I would say also that there have been many years on the security side, and you know that we have kind of a security system here in Canada that is provincial. But we have been trying to keep up with the changes in the market, and quite often we don't get the attention to make the statutory or rule changes that we need to make. Since the crisis, there has been a commitment by governments to actually undertake these changes that we've been asking for. And so it has allowed us to be not only to expand the boundaries, but also to be much more surgical in our approach, because we have the right tools. So I'll leave it at that.
Thank you, Maureen. Porcupines mating. Use that again. Shayla, Much of your life at the World Bank and before that at the fund has focused on financial stability. From your perspective, what do you see as the major achievements of the post-crisis remediation process? And in your view, is there unfinished business?
So thank you. First of all, it's great to be here. I think, as was said, Toronto Centre has done a great job and really relevant given the circumstances that we are in. And I cannot help but agree with a lot of the things that Bill said. So I remember back when I joined the fund in 1992, there was the Nordic banking crisis. Norway, Sweden, and Finland were all going through a major crisis, and each really dealt with it in a very different way. So there were a lot of lessons in terms of how to resolve a crisis, because this doesn't work? Okay. Okay, so as I said, the Nordic banking crisis was late 80s, early 90s, and each of the countries dealt with the crisis in a very different way. Stefan was there dealing with the Swedish crisis, and there were different ways of resolving the crisis. Then came in 1998 the Asian crisis, which was very strong and led to a lot of economic and social costs for many of the countries involved, which then led to an emerging markets crisis. And at that time, what was put in place was the Financial Sector Assessment Program. It was right after the Asian crisis. And the idea was that there should be a peer review, if you like, or a review rather by the international institutions based on agreed upon international standards in terms of the vulnerabilities in those different countries, but also the effectiveness of the oversight system. So be it the banking regulator, insurance regulator, securities regulator, and so on. And what the FSAPs provided was actually a diagnostic element of it to see what are the problems in the system, but also what is a way to make sure that the regulators can have the systems in place to deal with both the vulnerabilities in the system, but also if there was any shocks to the system, what needs to be done in terms of the safety net as well as the resolution. What I thought was very different, and then came, of course, to 2008. So every 10 years I have, in my 25, 30 years of career, I've seen a crisis. And what was very different in the 2008 crisis, and I'll put the US aside a little bit and more look at how Europe has dealt with the crisis, was that the landscape didn't change that much. So in the Asian crisis, you saw a lot of banks disappearing. So if you looked at the key banks before the Asian crisis and after the Asian crisis, the landscape was very different. When you look at the 2008 crisis, the landscape, especially in Europe, is not that different. The same banks are there, the same banks are active. So I think what I'm trying to get at is this importance of regulation, and a lot has been done with after the global financial crisis, unprecedented regulatory reforms. As we talked with Stefan many times, I never thought liquidity regulations would pass, because they were like 25 years, everyone tried to pass liquidity regulations, and it was only after the 2008 crisis that some of these regulations were passed. But I think if we think of the reforms, I would like to bucket them into four. One, regulations. And this 2008 crisis was mainly dealt with regulations. A lot of very complex and very good regulations, but very much in terms of focusing on the regulatory framework. The second aspect, which the fund and the bank has been pushing a lot, and here Toronto Centre is very relevant, is supervision. You can have the best regulations, but as long as they are not implemented, as long as they are not enforced, then you end up with crises, because risks go somewhere, and they are not necessarily. And that includes the evergreening of loans, any type of issues that surface during a crisis. The third is resolution. And here, I think there has been progress, because the FSB came up with this effective key attributes of effective resolution, which is a really critical piece of guidance in terms of what should be done in resolving the financial institutions. And that really is critical in my view, because we'll never be able to have enough regulation to be able to prevent failures. And it's okay to have failures as long as you have orderly exit. And I think that's really important to make sure that firms, financial institutions, be it fintech, be it large banks, are able to exit in an orderly fashion. And if you ask me, can some of the large banks, G-SIBs, can they exit in an orderly fashion? I don't think yet. So I think there we have a long way to go. And what comes with good resolution of banking problems, banking failures, is not forgetting about the root causes. And this is more of an issue in many of the emerging countries that we work on. The reason for banking sector problems or financial sector problems is non-performing loans. And you see huge amount of non-performing loans in emerging markets countries. Some of the numbers were mentioned before, also in Europe. And the reason for that is you can put a lot of capital in the banking system. You can fill up the hole. You can have asset management companies and other ways of dealing with the non-performing assets. But if you don't deal with the root cause of the problem, which is corporate restructuring, we will have the same problem again and again. And that's really the key issue in many of the emerging market countries, that the state-owned enterprises or vested interests or the enterprises that exist, which create a lot of the problems, continue to exist. So if we don't address the issue of corporate restructuring, in many countries, unfortunately, we may have to face the same problems in every 10 years or sometimes even quicker than that. And the fourth thing, which Maureen mentioned, is really important, is the role of the corporate governance, the role of the boards of the banks, the banks themselves, because at the end of the day, it all ends up with good management. If you have well-managed banks, you see that they also recover faster from a crisis. They take decisions that allow them to be able to deal with issues going forward. So there was a lot of effort in this after the 2008 crisis, and the Group of 30 have written guidance. FSB has looked at it. OSFI has done a wonderful job in really talking about what is the role of the boards, and this was really showcased role model for many of the emerging market countries. So I think those are the four buckets, if you like: the role for the financial institutions themselves, the role for the regulators, the role for the restructurers or the resolution agencies, if you like, and the critical role for supervision. So unless we make headway on all of these four issues, I don't think we can say we are done yet. So we may be done with regulations. I think we actually have a lot of very complex regulations, which are adequate for some countries, but they're not adequate for many of the emerging countries that we work with. So the key here is how do we make sure that those regulations are tailored to and in a proportionate way to many of the emerging market countries, because it's no use for them to try to implement Basel III when the fundamental issue is much more principle-based regulation supervision. And really, we really need to make sure that regulations are proportionately applied. And finally, for many of the emerging market countries, the efforts of after the 2008 crisis was the Basel Committee worked on very important pieces of regulation. IOSCO and others worked on very important, CPMI worked on very important regulations in terms of securities markets, market conduct, and so on. Derivatives market regulation. So you had all these parallel efforts, great efforts in terms of regulatory reforms. And now I think it's important to say, okay, what is the cumulative effect of all this? What does this mean for some countries, especially emerging market countries? Are there any unintended consequences? Which doesn't mean any of the reforms needs to be rolled back, because a lot of these are necessary and were well thought out regulatory changes. But I do think we need to assess these cumulative implications and think of ways to dealing with them, be it risk sharing, be it other instruments, be it different types of supervisory guidance. I think that's another key element that we really need to look at going forward.
Good thoughts. Thank you, Jayla. Kevin Lynch, you get the last word on this round. Your past roles as a senior public sector policymaker and current role as a senior banker give you a rather unique view of financial markets and financial stability. Have the post-crisis reforms had a positive impact? Have they gone too far? What has the impact been on the Canadian banks?
Thank you, John. And as I mentioned to John, I'm going to totally ignore his question, and I'm also going to be uncharacteristically short. So in my remarks, first, I just want to start with I went back and read the vision statement for the Toronto Centre, which is, quote, "A world where financial systems are stable and accessible to all." You know, and that's a pretty impressive vision statement. In many ways, the financial crisis showed how vital meeting that statement is, and also how difficult it is, the two sides of it, the numbers that you mentioned, Kevin, in terms of the economic consequences and others. And so there's certainly nothing that's happened since you were established that suggests your vision is wrong, nor that there's ongoing need for it. What I'd like to do a little bit is, you know, we're now 10 years on from the financial crisis. And if you think about I just came back from the spring meetings at the IMF. I mean, essentially, we're declaring that we now have the most robust, strongest, most synchronized global recovery economy since before the financial crisis. And the issue is it mission accomplished, to quote someone? Or are there outstanding kind of issues ahead of us? And I think that's kind of where we have to kind of find the balance. On the one hand, the strong economy, and Bill alluded to some parts of this, is welcome. How we got to where we are, though, it's taken unbelievable amounts of conventional and unconventional monetary easing over a period of time that none of us could have believed was possible to sustain, nor should we have done it. I think, Gordon, if we went back to 2007 or 8, in terms of what's a temporary policy response to a crisis versus what's become pretty structural after 10 years. And we've had a start at monetary normalization in the United States, a little bit in Canada, but nowhere else really. Japan, nothing. Europe, nothing. Bank of England is dancing around it. So in a sense, we're not back to the status quo normal, whatever that is. And regulators and governments have done enormous amount in 3 areas. One, obviously, is to reform financial systems, and folks have talked about that. But they've spent an enormous amount of time to try and reboot their economies, which have really been devastated. This wasn't a cyclical downturn. In many ways, because it was an asset recession, it's actually been a structural recession, and we've learned a much harder to come back from. And the third, which is I think downplayed, is I think both regulators, governments, central banks have been trying to rebuild trust. I think the two things that are often uncited in terms of what we lost because of the financial crisis are trust in the financial system, and that we can get back, although all the numbers suggest we're nowhere close yet. But the other one is actually confidence in the emerging world in the Western financial system and model. And I don't think we're going to get that back easily at all. And that's certainly true. Spend time in Asia, and they point to the financial crisis as a fork in the road in terms of the perceived dominance of the Western model. And I think that's a problem for us ongoing. Let me go back to, at Davos this year, Christine Lagarde, the IMF, gave a very good talk on, in many ways sounded like Bill, the dangers of policy complacency today. She used the analogy, which goes back to President Kennedy, which is the time to repair your roof is when the sun is shining. And so we should use the time now when the economy is pretty robust, not to sit on our hands, but actually to do some of the structural things. And just going through the various kind of ones, repeating Bill a little bit, we've got an enormous number of structural growth inhibitors. Our potential growth in Canada is under 2%. In the United States, 2 or slightly under, Europe even lower still. So we're growing back into a world that's different than the world that we've known since the Second World War. And those growth rates probably won't give us the job growth, the income growth, and things that actually our populations expect. So we've got a structural problem even as we kind of restore kind of growth. Second is we've got enormous growth in social vulnerabilities. Income inequality is certainly one, growth of populism and other things. And then we're really at a pretty unique point in terms of geopolitical risks as well, whether it's nationalism, populism, reduction in a willingness for international cooperation, all the things that we've in many ways assumed as givens in the policy development in the last 20 or 30 years aren't really as certain today as we move forward. And then the last one is the trust issue, which I think is becoming a problem. I mean, it's hard to come forward with new policies as government or regulators if there's less trust in you as an institution. And we have lost institutional trust, and part of the populist movement is an anti-establishment movement, and for both good and bad reasons. So my broad thing is, when we ask the question, have we finished the job of financial sector stability repairs, you can't answer that independently from the broader context of the economy. The financial sector doesn't exist in isolation. It exists as an integral part, both affecting and being affected by the economy and the society that it actually serves and influences. And I think we have to spend a little bit more time going through that. Just two other points briefly. One, and again, Bill alluded to this, but I think it's not the same economy that it was 10 years ago. The change, I mean, particularly driven by technological change, it's an amazingly different economy. If you're in the retail sector today, it's an e-commerce driven kind of world. FinTech is changing the banking sector. Cryptocurrencies and kind of ledgers are changing the way we do kind of payments. So it's very different than the economy that we, in a sense, were dealing with when we looked at the financial crisis. Data, whether it's data privacy, data security, and increasingly now data usage, and financial institutions are enormous data vaults, they're enormous data users. Where we come out as societies and regulators more broadly on the data stuff is going to impact and be impacted by kind of the financial sector will play a key kind of role in all of that. And then from a Western perspective, China is increasingly wants to be part of the rule-making process now, not the rule-taking process. And that's very different. The financial crisis was sort of at the end of, in a sense, a single polar world. We're not in a single polar world now. We're in a multipolar world. And the way we make and develop the rules are going to have to accommodate kind of different approaches to things. And I think that's going to make it more complex. If I can just end by having been involved during the crisis as well, my own takeaways, and it's from observing, is one, and the Canadian system was a little bit different than some of the others and actually behaved a little bit differently than some others through the course of it. First is I'm a strong advocate that the value of regulatory principles over excessively prescriptive regulations. I think it served us well before, and I think that's particularly true in times of great change. It's hard to prescribe, for a world that actually you can't describe tomorrow. You have to have accountability, but I'm very keen on kind of more of that. Second is, I think, and again, I think the Canadian system was relatively simple. I think simplicity over complexity. The purpose of regulation is to change and influence behavior. If it's so complex you can't understand it, it's pretty hard to assume that it's actually going to have its intended consequence, let alone the unintended ones that Bill was worried about. Third is, I think that we underestimate how important regulators and supervisors are to the system. Shayla, I think you mentioned you can have perfect regulations, but if we don't have them, and we have to have regulators who actually understand the system, not just domestically, but internationally, and are willing to kind of talk to kind of their colleagues elsewhere. So in a sense, part of the systemic nature actually comes from the regulators. And lastly, we have to build always resiliency into our system. And the danger is that we actually build backward-looking resiliency into our systems rather than forward-looking resiliency. And I think part of the challenge is we've got to be building resiliency for the economy that we don't quite know yet versus the economy that we actually had a decade ago. Thank you, John.
Kevin, thanks. I think that was a very good answer to my question, or a good answer to a question. And with that, we'll move to the second round of questions. And in this case, I'm directing one question to each of you, and would like you each to answer it in your own way, based on your own experiences and preoccupations. And the question is: since the crisis, significant new risks to the global and regional financial systems have emerged. What risks are of particular concern to you? And Chela, I'd like you to go first, please.
Okay, so some of this.
Oh, there you go.
Some of this was mentioned by Bill. What we worry a lot about is buildup of debt. So you heard some of the numbers. That we have 45%. So the low-income countries at high risk of debt distress are greater than 45% of total. This is sovereign debt. Levels not seen since the HIPC initiatives we are seeing now. So sovereign debt has increased very sharply. Corporate debt levels, especially in emerging markets, are exceeding public debt, sovereign debt, and really China is one, but it's all over globally. So corporate debt has increased a lot. We also see new players, new investors, so be it mutual funds, pension funds, asset management companies, ETFs, and so on and so forth, in emerging market space, much more than so in the last 25 years. Which is good, because a lot of these countries need, they have infrastructure gaps, and they have all sorts of financing, long-term financing needs. But the concern is it's very concentrated. So there are about 12 or so asset management companies which are very large. They hold 85% of emerging markets debt. You have very large pension funds, which again hold a large proportion of emerging market debt. So the concern is if these are long-term investors, great, but if they do not differentiate and move out of emerging market countries, that could create a lot of issues for them. The last but not least is this whole issue which links to what Kevin said about trust. And what you see is since 2008, a huge increase in digital currencies, digital financial systems, and which brings a lot of opportunities, especially as the World Bank. We work in many countries which people are in remote areas, so digital financial services allow reaching those that are underserved. But at this there's also credit history, which can be using many other data points and information. So credit scoring, know your client rules with digital technologies. So there are huge opportunities, but also very large risks. Not alone cyber risk, but also financial literacy concerns. One of the issues is that you don't want to hurt those that are most vulnerable, that now have access. So data privacy, data residency, persistency of data, what you give out today may have implications 10 years down the road, and it sticks. There's the persistency of data. So there are a lot of issues related to the technology and the opportunities it brings, but also the risks that it poses for those that are most vulnerable.
Thank you, Chela. Kevin Lynch, would you like to go next?
Thank you, John. And I'll pick up on some of those. The first one I raise, and this is the point that Larry Summers has made a couple of times, is that we have an aging expansion rate now, but we have a threadbare toolkit to deal with it. He had the statistic that the average of the monetary policy response to previous downturns in the United States was in the range of 400 to 500 basis points. That would be difficult at current U.S. interest rate levels, even more difficult in other jurisdictions besides the United States. And on the fiscal side, with the current U.S. tax reform plus the new spending bill, the CBO estimates that the U.S. debt to GDP ratio within 10 years will go over 100%. And the last time it was there was after the Second World War, and we're probably not going to see growth in the next 10, 20, 30 years as we did at that time. So I worry a little bit just that, in a sense, there always will be another downturn. And what you really want to do is be well prepared in terms of having the toolkit ready for it. And I'm not so sure the toolkit is in as good shape as it should be. That's my first. Second is I think we have a growing number of sectors of the economy because of technological change and kind of a merger of activities because of that are outside of the regulatory ambit. The fintechs we know, but increasingly the info techs are getting into this line of business. Alibaba, it's an infotech firm, it's a fintech firm, it's both. What exactly is it? Who exactly regulates it? And how do you move stuff in between? And its only example. In many ways, I think we've got a lot to learn from China in this, because I think they're ahead of us in actually the kind of application of new technologies to many things. But it's outside our regulatory ambit. So we spent a lot of time, this is the hindsight point I made earlier, making sure that we have a kind of a system ready if we have a repeat in the current system, but I'm not sure we've thought ahead enough to make sure we've got the resiliency for possible future systems, which is complex, but that's why we have regulators. Third one is that I think that there is a decline happening in international coordination and cooperation, and we all know how important the Pittsburgh meeting kind of was in kind of 2008 to actually find a kind of new short-term and single-purposed Washington consensus to get us forward. That seems to be dissipating now for all sorts of reasons. You're starting to see, FSB and others may have agreement on the principles, but the implementation at the national level is starting to diverge, and I think we'll see more of that over time. That isn't good, certainly not for countries like Canada. We actually want strong international coordination and cooperation. I think most should do it. And my fourth one is the data issue again. Increasingly, banks, like every other company, are going to be driven by data. And I think that we're going to get some merger a little bit of kind of regulators in the non-bank space that deal with data protection, other things, starting to kind of intersect with the banking sector. And the better we do it ex ante and think it through at a principle level rather than back into it because of problems, I think the better off would be. My last one is that we have an underlying structural challenge, I think, which is that we're in a world of the fourth industrial revolution, Tech 4, you call it, whatever in the heck it is, which is moving at a pace and a scope and a scale that's really pretty unprecedented. But actually governance is actually moving pretty well at the same pace it's always gone. And so you've got a natural growing wedge between the pace at which the world we're trying to regulate is changing and the ability of policymakers. Regulators may have a little bit more scope, but actually parliaments and Congresses don't look like they're moving any faster today than they were before.
Thank you, Kevin. Kevin, you alluded to non-banking regulators. Maureen, do you want to go next?
Sure. So I absolutely agree with the two speakers that the world that we're going into is not the old world. It's a very different world. And so, the question is, are we, with the reforms, have we pushed risks into new areas? And I have to say that there are a lot of risks that we just don't know what they are yet. And so I don't think that the system that we have today or the issues that we've been repairing from the past are going to help us in the future. I think that we really have to sit back and start thinking about regulation without so many boundaries. We have to really either have intense coordination, or we're going to actually see businesses continue to innovate into the spaces in between. And so, and that's what happened in 2008, and that continues to happen today. So I think also that we've moved through the changes to the derivatives regulation. We've certainly, it's much more transparent. We can see the risks building. We can see trends developing. But there's another risk that comes out of that, and that is now they're centrally clearing, and they're centrally clearing on very few platforms. So there's a systemic risk right there.
Right.
We have to start looking at. The other thing is that you were talking about the expectations of Mr. and Mrs. Main Street. And the issue there is now people are getting very, very low returns. They are suddenly starting to see some of the charges for getting those low returns, and they're now fleeing and trying to find passive investments that give them some kind of return. So we're seeing a huge increase in the amount of ETFs. And now the ETFs are, I mean, they're getting to the size that they could actually potentially start driving the market on their own. And the question is, how big do they get before they start driving the underlying? So that's another issue. The other thing is that there's been a huge focus on banks, as there should be, and on de-risking banks. The issue with that is it's perfectly fine, but to de-risk banks, you basically move some of the activities that they have off of the banking platforms and into the market-based platforms. And there, what we're seeing is innovation in between regulators, where we're seeing things, growth of syndicated mortgages. We're seeing a huge growth in MICs, mortgage investment corporations. And so they're kind of innovating right in between insurance and securities and some banking. And so they're very small still at this point, but that can grow substantially. So, and then the last thing I'd say around confidence in the market, I think it's been shaken dramatically. And people are now saying, I want my rights protected. I want to know when I go to an advisor that I'm actually getting advice. I'm not just getting sold. And we're seeing that wave move across. It's moved across Europe. It's moved into the Far East. It's moved into Australia. And now I think you're going to see more and more a push that the consumer wants protection. And so I think we're not going to get that confidence and stability back if the people who actually need the markets to work and banks to work effectively for their future, I don't think that we're going to get that confidence back until they feel confident. So there's still some work to be done.
Thank you, Maureen. Kevin Steiro, what new risks to the global and regional financial systems are you most concerned about?
Like many other folks in this room and on this panel, we're very focused on data and technology and emerging cybersecurity risks, but I'm not going to talk about those. I'm going to talk about one very traditional risk and one less traditional one. So on the traditional side, U.S. credit markets overall appear healthy, but there are certainly pockets of concern, particularly on the corporate side, where we see some of the trends that were mentioned earlier in terms of increased leverage amongst firms, a larger share being issued in the near speculative grade area, fewer covenants, less protective non-price terms associated with corporate credit. We are in an environment where interest rates look like they're rising. That potentially exposes firms to increasing debt burdens going forward. That has the potential to be amplified by some of the changes that were part of U.S. tax reform, which impacted both the deductibility of certain interest expenses and the ability for firms to carry back and carry forward losses. So all of that is pretty complicated for firms to understand, but it's certainly a risk factor. Also on the corporate side, commercial real estate is something that we've spoken quite a bit about. Prices remain very elevated, and we've given guidance over the last few years about commercial real estate concentrations, particularly for the smaller institutions, where in some cases that can be many multiples of a firm's capital. And that's an area of focus for us as supervisors. The less traditional risk that I'll mention also came up earlier, but it's really around firm conduct and employee conduct at firms. And misconduct risk is a concern of ours. We've spoken a lot about it at the New York Fed. And I think it's important from both a micro-prudential perspective and also potentially a broader macro-prudential or financial stability perspective.
On the microprudential side, by some estimates, there were over $300 billion of fines that have been paid since the financial crisis worldwide. That is a direct impact on firms' resiliency. There's also the impact on management's time and attention, which can distract them from running the business. On the financial stability side, the word trust has come up a few times, and I think that's an important part of it. And when we think about the role of the financial industry as a whole, playing this critical role as an intermediary between savers and borrowers, trust is absolutely critical for that. And I think that's an example where one firm's behavior has the potential to spill over and harm others more broadly. So when we think about this, one way we've tried to frame this is in the form of a firm's cultural capital. So think about an intangible asset that a firm has that influences its firm's behaviors, their decision-making, and ultimately the outcomes that matter, both from the private sector and the public sector perspective. And like other forms of capital or intangible assets, firms can invest in this through purposeful choices, and they can see their cultural capital depreciate over time if they don't pay attention to it or in response to employee misconduct. So I'm an economist by training, so I like to think about when might markets fail in a way. So our hypothesis is that there are market failures here that will lead firms to underinvest in their amount of cultural capital in a way that could hurt the financial industry as a whole. So what are those frictions that might lead any individual firm to underinvest? You have standard principal agent problems where incentives might be misaligned between firms and their employees. You have potential externalities or spillovers associated with the trust or the potential breach of trust that one firm's misconduct could have on the broader financial system. And you have standard asymmetric information problems that can also prevent firms from understanding where they need to invest in their cultural capital. So those kinds of ideas are what lead us to the conclusion, or lead me to the conclusion, that there's a role for the official sector in trying to understand and influence firm conduct. It's not just something the private sector needs to or can manage by themselves. Ultimately, each firm has to be responsible for their own behavior, for the behavior of their firms, but the official sector can play a role to facilitate this. And we've seen a lot of work on this worldwide. The Dutch, Australia, Canada, the UK, lots of foreign jurisdictions are thinking about how we can bring supervisory tools to bear to try to push firms to have a stronger culture and better conduct in a way that would support our ultimate goal, which is the sustained provision of financial services.
Kevin, thank you. Stefan.
Well, I mean, I've been through so many banking crises in my own country and different corners of the world, so I hope that I don't have to do it again, but if it happens again, I know how to do it, so I think that that's okay. Bill started out talking about debt, and so have others. And debt, you can have public sector debt, you can talk about corporate sector debt, and you can talk about household sector debt. Mostly when we think about increases in debt, it tends to be public sector debt, which has been a problem in the past. We ended up with an enormous problem on the public sector debt side in the 90s, so we spent 20 years trying to get out of that hole. So what has happened in my environment is that on the one hand, public sector debt is maybe at 25% of GDP, something like that, on the low side. But private sector debt went up by much more. So net for the system as a whole, we still have more debt than we ever have had in the past. And then one particular concern, which also to some extent is a Canadian issue, is household sector debt. In my environment, we're hitting 180% of disposable income, which is a high number, almost identical to the same number in Canada, by the way. But then one needs to be mindful of the fact that that's for the aggregate. Older people don't have a lot of debt, and that means that we have many households with a debt to disposable income ratio of 400 to 600%. And most of that is actually variable rate mortgages. And that means that these households are basically betting that rates will never ever go up. Because if that were to happen, then of course that's a problem. Right now, house prices have started falling, and that's remarkable, being mindful of the fact that my institution has been around for 350 years this year, and we have had a negative rate for 3 years. And with falling house prices with a negative rate, then it's hard to understand fully what has been going on there. What is supposed to save the day? And that's the story in many, many countries. So it's not only my own country, it's this thing called macroprudential. Macroprudential is essentially about saying no. And so far, my experience having seen macroprudential in action is that it's incredibly hard for politicians to say no. And still in many countries, like my own country, they have a strong preference for dealing with macroprudential issues. So far in my environment, we have put in place a number of macroprudential measures, but all of them have only dealt with new loans, because then you don't have to pinpoint to whom you are saying no. You can always fool yourself thinking that it's not your own voters, it's somebody else's voters. And that means that so far our macroprudential measures have not been very, very effective. And that means that macroprudential maybe saves the day in some places, but in many places over time, probably not. And that's because one way of thinking about this is that at one end of the spectrum, you have monetary policy. In the middle, you have this thing called macroprudential. And at the other end of the spectrum, you have what we normally call fiscal policy. And essentially, when you deal with housing market issues, it's a combination of those three. And if you refuse to do things on the fiscal side, if global interest rates are set by somebody else abroad, because that's what happens in a small open economy, well, then you're stuck with macroprudential. And if you don't do enough on the macroprudential side, that's likely to come back and haunt you eventually when rates go up. We kind of presently in my own country go through a period where the younger generation tend to say that this time is different. And it's different to them because they have never seen things go on. But I'm still wondering where it will take us over time, because if you've been around long enough, you sort of learn the hard way that prices do go up, but they also can go down, even if it takes a while before they go down. Having said that, that was about debt, and particularly household sector debt, and the numbers are remarkably similar between Sweden and Canada. I hope that in both cases we don't run into trouble in the future, but I do think that the odds are against us. Not either because we mess up domestically, whatever that means, or because there's a major external event in the rest of the world and we're just hit by that event. It's hard to foresee what that could be, but you never know what happens in the future. The other part of this, which also is likely to come back in one form or the other, and other speakers have already alluded to it, is that when rates go up in the world, or when long rates in the US go up, it would be absolutely remarkable if not one single emerging market runs into trouble. That has always happened in the past in one form or the other. Argentina is high on the agenda presently. Eventually, my guess is that there are more to come. But the real, and that's almost a philosophical issue, is how to deal with debt, given that we're carrying a backpack full of debt. It used to be that when we talked about fiscal policy, the assumption was that that creates a problem, so let's do something on the fiscal side, like the Maastricht Treaty, which put certain limits on how much debt you can accumulate over time. But we haven't gotten to that point when it comes to private sector debt. So far, we just don't know how to deal with private sector debt, and when it ends up being too much of it. Well, we know ex post, but we'd like to deal with it ex ante. And the philosophical question is the following, and I don't know the answer to it. On the public sector debt side, we sort of used to think that public sector debt explodes if we expand aggregate demand, increasing the deficit, if the increase in growth is lower than the increase in the debt, because then that's not sustainable. Now, if we put a cap on that, and then everything is moving to the private sector because we just produce more and more in private sector debt, the same assumption holds. Either the pace of the increase in public sector debt has to be lower than the growth rate, and the whole thing will stabilize, or the opposite holds. And then we eventually end up with some kind of a problem. And this latter issue is something that hasn't really been discussed a lot when it comes to conversations about monetary policy, because when we sort of do monetary policy, we take for granted that if you push down the policy rate, then growth is going to go up and inflation is going to come back, and eventually the problem will go away. Whether that really is the case or not, we just don't know. So my guess is that given what I've just said, the Toronto Center will stay in business forever.
Seven, thank you. I'd now like to take some questions from the floor. You can direct your question to one of the panelists or Bill, or you can direct it to me and I will allocate it as I see fit. So, are there any questions? Yes, John Pattison.
I just wanted to add, everything is very believable, starting with Bill's comments today. But it wasn't until Stefan's comments about the type of stresses that I think we really start to have to appreciate the problems in coming years. Because we know that the, say, bond market stresses, you have to be old enough to remember when the bond market got angry and chewed up governments. Or in the future, perhaps an ETF crisis where people can't get to the exits in time, exacerbating the fall in the in equity markets and then triggering things. So I think that from what Bill said and what Stefan Ingves was saying here, I'm actually more worried about the two things. A, the type of crises and shocks that we could get. And secondly, Bill alluded at the end to the fact that we could have a delayed crisis because of political issues, always pushing things into the future. And secondly, they're demographic issues. So the role of a supervisor is a bit like a bomb disposal person in a way that you know it's ticking, and you don't know whether it's going to blow up. You know, it might not blow up, you might be lucky, but it puts you in an awkward position as a supervisor trying to manage this type of crisis. So my point is, I think it's worse than what Bill and others have said, because you don't know to what you will be stressed in these crises, which makes stress testing all the more important, and why banks should not be discouraged, banks have tried to discourage aggressive stress testing, but I think in this kind of environment, you probably should be going for tougher stress tests. Anyway, I'd be interested in observations.
Thank you, John. Kevin, you're deeply into stress testing. Do you want to comment on that?
So I think your basic framing is right. And one way to think about this is you have shocks and you have vulnerabilities. And when we think about the U.S. financial system, we typically try to understand the vulnerabilities of the system through things like valuations, leverage, who's holding certain types of debt, maturity or liquidity transformation, and that set of vulnerabilities could expose a firm or an industry to a whole range of different shocks. So trying to identify a specific shock in a transmission channel is a very challenging exercise. And one way to think about it is to ensure resilience to a broad range of shocks by reducing the vulnerabilities. That's both firm level vulnerabilities through a stronger balance sheet, capital, or liquidity. It would be system vulnerabilities by having things like a reformed tri-party repo system, central clearing of derivatives, et cetera. And that makes the system as a whole more robust, more resilient to a range of shocks.
Thanks, Kevin. Other questions?
John?
Yes.
Yeah, thank you.
Fred.
Excellent discussion, and I guess I'm intrigued by Kevin's comments on cultural capital. I think this is very, very important and very timely. But I confess I'm just a little bit uncertain about how you, what the right regulatory response to cultural capital is in a framework that says keep it principles-based, keep it simple. And I'm wondering if there really is a role, a particular role that the Toronto Centre might play through its work with supervisors in maybe increasing the emphasis on the importance of cultural capital, and whether that might be an effective way to try to get at the issue.
If the Toronto Centre doesn't do it, it could be a whole new consulting business, Peter Doyle. But, Kevin, could you give us a quick definition of cultural capital?
So the way we think about it, it's the set of norms and behaviors, the way things are actually done at a firm rather than what's written down in a risk management practice. So
it goes beyond the Wells Fargo.
Well, I'm not going to talk about any individual firms, but you're hitting it exactly right about what the challenges are with this, and that's really on the measurement side. And when we speak about this both to our other supervisors and with the firms that we supervise ourselves, there's a lot of interest in the concept. As I mentioned, supervisors around the world are trying to figure out how to do this in a more systematic, measurable, comparable way. But that's the challenge in front of us. My view is just because it's hard doesn't mean we shouldn't do it. Begin with a framework, begin with some concepts, and build the measurement, build the evaluation tools over time. And our colleagues in the Netherlands, I think, have really been the most innovative in this area, bringing in a whole range of perspectives to think about how decisions are made at firms, what sorts of behaviors are conducive to good risk culture, to a good decision-making framework.
Maureen.
Yeah, so in the securities world, we think a lot about conduct, and I think should I use that? I think I would kind of define it as quantifying conduct risk and mixing that with reputational risk. And so in our world, what we see are, we look to the compliance programs that are in place and how they're tested to see what actually happens in a firm. But quite often, the problem is it's a tick box exercise. And where it really should be measuring, are our programs incenting the right behavior so that the outcomes are right? And quite often it's a series of actions that they go through to say that this has been done. And so it's very difficult. And I would say that we've got a lot of experience with conduct, and it's never easy because people are very, very smart, and they will put in incentives for the right behavior, but if you don't get them exactly right, it's actually the worst outcome.
Are there other questions? Barry?
I'm just wondering, over the many years now, we've seen a sustained level of consultation, cooperation, harmonization. Kevin Lynch alluded to pressures pushing the other way. How do we keep this going, or will it take another crisis to bring us back to that role again?
Kevin Ingves, do you want to start?
You just have to keep talking and talking and talking, and make sure that even if it's difficult to do the talking, you sort of try to keep the same group of people in the same room, hoping that the whole thing won't fall apart. Eventually, when it comes to forging international agreements, all those who are involved need to conclude back home that we're actually better off sort of doing this compared to not doing it. But there's not much foresight when it comes to that, so usually things have to go wrong a bit first before you actually get it back on the road again. One thing that has changed over the years is that people tend to accept much more transparency today than in the past, and that's helpful because if you want to go astray, then at least you are expected to tell others about what you are doing, and that's kind of a correctional factor in all of this. But as Chela said, with hindsight, one would have thought that it would have been a natural thing for the Basel Committee when it was established, I think in 1976, to start out with the liquidity regulations, because lack of liquidity is usually what makes you go under. But it just wasn't possible to do that because one attempt after the other failed because people just did not want to agree, and eventually then there was a window of opportunity to get this thing done. So everything moves on the slow side. That's just the way it is. So you have to just accumulate a lot of airline miles to go to Basel and other places and just keep talking. And because there's no other alternative to that today, because we just don't have a global system. And we do not have a global system because there is no, at the global level, there's no court of appeal. You can't appeal to the moon. So sovereign nations can say yes one day and then they can wander off the next morning and do something completely different.
We've seen that.
And then it's sort of like herding cats, and then you do your best, hoping that everybody, at least to some extent, is running in the same direction.
Kevin Lynch, did you want to respond to that as well?
Just to broaden it a little bit from Stefan's answer, which is that, you know, everything is interconnected and interrelated. So take trade, which is not unrelated to the financial services. It's clearly that we have got impending ruptures on the multilateral kind of trading system today, partially the United States, but other countries as well. So we're not in the cooperative mood on trade facilitation that we were previously. I think on the data side, you're going to see a very different approach to data protection and usage in Europe through the data initiative than you are in North America potentially, and who knows, between Canada and the United States. And China's going in a completely different place where there will be no rules on data usage within the Great Firewall of China, but actually you will not be able to move the data outside of China. So you could potentially have three very different regulatory approaches to something that in a digitized world is as fundamentally important as the movement of data. So I think we have to continually worry about this and worry about the interconnectedness, because that latter one can come back and start to affect our banking coordination. Even though it didn't start there, it actually could end up being a problem there.
Okay, Sheila?
I just wanted to add to it. I think if you look at the headline, it looks like collaboration perhaps is less or declining. But the last 10 years, the amount of collaboration across different levels, technical levels, has been really unprecedented. So you see a lot of working groups which were really working as part of a lot of these regulatory efforts, be it at the securities regulator, banking regulator, whatever. So that I think really led to a network of technical and supervisory regulatory community which works much collaboratively together. And I think that and the need for transparency and also various programs like peer reviews, or be it the IMF, World Bank, FSAPs, or other types of assessments which try to hold everyone to certain norms, I think will perhaps make it much more persistent in terms of collaboration at different levels. But you're right, at the policy levels, you see that divergence. Perhaps that's to be expected because the crisis was very forceful and everyone got together because there was no choice. But I think it will be really critical to keep that momentum in terms of the technical collaboration, be it how stress tests are done, be it how we deal with some of the regulations going forward.
Thank you for that. Now we're going to start to wrap up by moving into the fourth round. And I'm going to ask each panelist to give fairly quick answers to 4 questions. First question is, can we expect another major financial crisis in, say, the next 5 to 10 years? 2, are we better prepared for the next crisis than we were for the last crisis? 3, what should regulators and supervisors be doing to further enhance our preparedness? And 4, do you have any final messages for this audience other than pray? So, Stefan Ingves, you go. Please go first.
No, I don't foresee a kind of a global financial crisis within the next 5 to 10 years, but when I worked at the IMF, I explained to the then managing director, Horst Köhler, that on average, there is about 5 countries each and every year working hard towards the next disaster. And it will continue that way because we human beings just simply don't learn when it comes to this. It's too tempting to create too much leverage in the short run. So it's just too hard to stop that. But not at the global not at the global level. Are we better prepared in some places? Yes, in other places not. But those who have been through a financial crisis will never forget. So in those countries where it happened, people are certainly better prepared, and it takes a couple of generations before that knowledge dissipates completely. What was the third question?
What should regulators and supervisors be doing to enhance preparedness?
Try to imagine how things evolve and what might happen when things go really wrong by doing case studies, war game type exercises. And that is important, and it's very, very important for the following reason. This is, now we are in a business school environment, and I went to business school myself. But when you do case studies in business schools, all the cases are successes. So people have almost no training at all dealing with stuff that went totally wrong. And that's why it's so important to actually train based on cases when things go completely wrong, and it forces you to start over again, because it's only going through those exercises, through that type of training, that you can get a taste of the mental mindset that you need to have when you sort out a mess, which is completely different from the mindset that you have when you expect to be highly successful. And based on this, we'll just have to keep at it. And it's not enough just to pray. I mean, in the end, you actually have to do these things yourself in order to better understand, remember, and try to learn from others. Never forget.
Thank you, Stefan. Jayla?
Okay, so another crisis 5 to 10 years for sure. I also agree with Stefan. I don't necessarily think it would be global. One issue that we did not discuss, but is really a lot in the agenda of the World Bank, is climate change. What are the implications? What is the role of the financial sector? Does that necessarily lead to a financial crisis? No, but there will be stranded assets, there will be implications. So I think we need to be better prepared for that. We are, I think, much better prepared for certain types of risks. And I don't think we can ever be prepared for all risks. So we need to be, I think the role is to be prepared, crisis simulation, stress tests, really making sure that we monitor as much as possible and take actions is going to be critical. And I think the message is, I actually don't mind crises. If crises are used well, they are a way to really, never waste a good crisis, as they say. It's a way to regenerate. As long as we can minimize the cost of a crisis, I think it's okay. So the question is, how do we minimize that cost? How do we, and I come back to orderly exit. To me, that's really critical.
Good points. Kevin Steiro?
Thanks again for the opportunity to be here. This has been a lot of fun. So when I think about the questions that were asked about what could come next, I'll go back to the probability of default, loss given default framework I mentioned before. Looking at our financial system in the U.S.,
I think the industry is more resilient than it was 10 years ago. We have something on the order of $700 billion more equity than in the past. Capital ratios are roughly double. $2.5 trillion of high quality liquid assets, less reliance on short-term funding. But those are traditional remedies for traditional financial shocks. And they do not necessarily provide the right support for all types of shocks. So when you think about operational risks broadly defined, a cyber event in particular, I think that is something that we definitely need to do more thinking about. So that's the probability side. On the loss given default, I think the progress is a little bit more mixed. So we certainly have made progress in the sense that some firms are simpler than they were in the past. We have protocols in place around resolution, but when you think about a single point of entry regime, it is enormously complicated. It is untested. We don't know exactly how this will work in the moment, despite all the progress that has been made by the FSB and others. There are really deep questions about governance and decision rights, questions about funding and who will provide it and how much, questions about communication strategies. How would that kind of resolution strategy be perceived in a world of no bailouts after the financial crisis? So I think there are a lot of challenges on that front. In the US, we have fewer tools. Some of the things that were taken away from the regulatory community around providing lender of last resort, provision of liquidity in the moment, that is a more complicated question than it was in the past. So trying to balance those two is really difficult. The advice to regulators and supervisors, including myself, is really don't be complacent and focus on solving the crisis from 10 years ago. As many people have said here today, the economy is different, the provision of financial services are different, and the likely shocks and vulnerabilities that we'll face going forward will be different. So thank you.
Okay, will there be a crisis? Yes, I think there will be. Chayla, from your every 10 years, it should be right about now. And Stefan, you said every 20 years, so it's coming up soon. I don't know if it'll be a global crisis. I hope not, but we definitely will have one. Are we better prepared? I think in a couple of areas we definitely are. A lot more transparency around what's actually happening in the market. A lot more sharing of information and data so that we can understand it across different sectors. And the other thing is that I think we're doing a lot more simulation and a lot more roundtable exercises to understand if this crisis hits, what would you do and how do we all speak to each other? So cooperation is much better, but it is still in the areas of the last crisis. There are still areas that we're not looking at. For regulation and supervisors, I think supervisors and regulators, when they're going in and reviewing programs, whether it's prudential or conduct, you need to ask some really tough questions. You can't just go through and look at what are the actions that you've taken, but really, do you know what the outcomes are? Do you actually know what is going on within your organization? And I think encouraging supervisors to really understand the principles of how they're supervising whatever that aspect is that they are, and to really ask outcome questions, I think is important. And last is, other than pray, I would say that I think organizations like the Toronto Centre are going to be very important, not just to talk about the lessons that we've learned from this past crisis, but to go back to the basics and talk about the principles around supervision and why it's important that there are supervisors. I think some of that gets lost in the nuances of trying to respond to what just happened 10 years ago. There are some basics that we need to ask.
Thanks, John. Well, I mean, we're certainly going to have another downturn. what it turns into depends on a lot of the issues we were talking. So one is a certainty. This time is not really different. It's actually, we're cycles. I mean, some people remember Gordon Brown's, in a moment of policy euphoria, before the financial crisis, declared that cyclical downturns had been confined to the dustbin of history. And about a year later, we had the worst financial and recession. So be careful about predictions. So we're going to have another one. I think we're much better prepared for the last crisis if it were to happen again. My concern is it's not going to be the last crisis the next time around, so we should worry about that more foresight. I do worry, as I said, that we have less of a response toolkit, monetary, fiscal, and in certain countries, as Kevin said, even kind of regulatory ones as well. And that's not a smart position to have ourselves in, given the certainty of a downturn. And what we really want to do is minimize the impact of it. The other thing that hasn't been raised, but I think is worth thinking is, I go back to my trust and populism. You know, there wasn't much. Trust levels were high going into the 2007-2008 recession, and populism was non-existent, certainly in measured form. And you know, populations took enormous hits, but were willing to let regulators and central bank governors and governments do their thing. I'm not so sure in an economic shock, given where trust is today and given populism, it's going to be the same degrees of freedom between kind of the popular mood and governments. I'm not sure what it implies, but I can't believe it's the same as it would be with the same degrees of freedom to regulators like Jeremy and central bank governors to go and do what they think is right, you know, for longer term reasons. I think it's more complex, and we should get that in our minds. In terms of what I would suggest, I think the more we can invest, a little bit Stefan's point, but generalizing it, the more we can invest in the soft infrastructure of cooperation and coordination, it pays off long term. Every time that I've been involved in crisis, it's actually knowing people to talk to in other countries, other regulators, in your own domestic financial system. You lose that network connectivity. That's the most important first line of response in any crisis remediation I've ever seen. And so we should invest more in that. And I think that shows the value of institutions like the Toronto Centre.
Okay, well, thank you for that. Bill White, you want the last word here?
Yeah, thank you very much. Can we expect another major financial crisis? I think there's a very, very high probability. I think it will be global because of the interactions on the trade side, the value-added chains, the financial services. Everybody's looking at the same Bloomberg. And I do remind you, in 2009, investment collapsed all over the world. And it was all a question of confidence in the light of the crisis, okay? Even in countries that basically had no underlying problems. So I think it will be global. I think it will be worse. And the basic reason for it is that the imbalances that I spoke about before, the level of debt globally is now so much higher. So what does this mean going forward? I think for the Toronto, for the Toronto Centre, as I look at the work that they do, there is a division, as it were, between crisis prevention measures, which really have to do with issues of implementation and best standards and how do you go about doing it. I think that the balance should shift in the direction of the crisis, the very good work that you already do, but on crisis management, because there is a very reasonable probability that everybody's going to get drawn into this. And then the question becomes, and I don't think we've made a hell of a lot of progress, things, for example, like lender of last resort, and Kevin has already mentioned, Dodd-Frank got some problems. Dollar is used everywhere. Where the dollar is going to come from? Things like deposit insurance. Think about Europe in particular, where we need European deposit insurance in euros. A memorandum of understanding, which in a lot of countries don't exist the way that they should. I was pleased to hear you talk about greater cooperation in Canada, but in a lot of countries, not so good. Insolvency regimes. The OECD has been doing a lot of work on insolvency regimes, and both for banks, financial institutions, households, corporations, and in many countries, the standard for the insolvency regime is nowhere near as good as it should be.
So the upshot will be that if debts can't be serviced, they won't be disserviced, but they will be not serviced in a disorderly way. And we can do something about that. But it's got to be done ex ante, preparing for crisis management. And lastly, I think we should be doing a lot of thinking in terms of crisis management about how to prevent countries with big sovereign debt levels almost immediately going into a state of hyperinflation. And this is a problem we've seen so many times in the past. It need not happen, but we should be thinking about all of that before. So my contention would be that the Toronto Institute should continue its excellent work. But if it were me, I'd be putting more emphasis on the crisis is coming. Are you prepared for it?
You'll be pleased to know, Bill, we have some excellent crisis preparedness and crisis management programs. Yes, that's focused on. So, I don't want to turn this into a long Toronto Center commercial. So I think we'll bring this to a close. I think you'll agree that this has been a most stimulating discussion. Some very thought-provoking comments from all our panelists. Please join me in thanking the panelists for their terrific contributions. I'm not going to try and summarize the entire discussion, but I think there is a consensus that remarkable and creative efforts have been made to stabilize the global financial system following the crisis, to reduce both the probability and severity of another crisis. Members of our panel and many others have contributed to this and are to be congratulated. But there are underlying causal factors that have not all been addressed, and the world and its financial systems are evolving quickly in ways that we cannot completely understand. So the job is not yet done. International financial institutions, central banks, policymakers, and the regulatory supervisory community that the Toronto Centre serves all have more work to do to try to keep pace with the changes that are taking place in the global financial system and in individual economies. In my long experience, and I'm probably the oldest person in this room, Bill, I think you and I might fight for that honor.
I won't fight you.
But one of the biggest contributors to past financial crises, at least, has been complacency. And Kevin, you mentioned, you referred to Christine Lagarde's remarks about the dangers of complacency. As one crisis recedes in the rearview mirror and the road ahead looks clear and inviting, we lower our guards and we allow excessive risk to enter the system, often in new and unexpected ways. And that seems to be a kind of immutable law of economies and financial systems. This could happen again, but at least I don't sense any complacency on the part of our panel members, our guest speaker, and so we can end our session on that optimistic note. Thank you all for attending this event. I hope you enjoyed it. This session is now adjourned, but there are refreshments just down the hall, and I hope you'll join us for those. Thank you. Thank you, Stephen. That was terrific.